times of the Nifty 50, which is very similar to what we've seen in terms of the Magnificent Seven. Lastly, I'll say this, and I think this is 2 points that people are missing. Number one, the Magnificent Seven, and really the top 10 biggest stocks in the S&P 500, have underperformed in the third quarter for the first time in over 2 years. Yet the market's hitting new highs. I think that's very notable. Why is that? Because you've got 339 stocks in the S&P 500 outperforming the market. We haven't seen that type of breadth and broader outperformance in almost 22 years. And I think these are things that people are missing. We think that speaks to the overall breadth and strength of the rally that obviously we still see continuing.
Was this because it was 50 and not 25, and the supersized cut led you to a supersized target?
No, we actually wrote the piece a couple days prior to. We wanted to see what the language of the Fed was going to be. Internally, in my own team, we were struggling with 25 or 50. At the end of the day, it's a great question. It's a moot point. We just happened to do it because we know that the market is on a short-term basis very reactive, and we knew we'd see some reactive moves after the Fed spoke on Wednesday, and that's why we published the piece before the market opened on Thursday.
I mean, we just had Leisman talk with Chris Waller, who made the case pretty clearly as to why at least he decided to do 50, or at least why now is the time. Let's listen to Waller real quick, then I want to open it up to the crew here, and we can kick this all around. Here's Waller.
Economy's strong, inflation is coming down, and therefore it's time to cut.
It's a short soundbite because that's all you really need. I mean, his point, Joe, being that they cut because they could. Inflation, he said, you take a look at the CPI, that sort of sealed the deal for him. The most recent one because it implies that the PCE is going to be below their target. So they did what we've been speculating they might be able to do for months. They cut because they could, not because there was some emergency where they had to.
And they did exactly what the bond market was suggesting they should do, and they fulfilled the commitment to the bond market. I also think the calendar was a factor in the reasoning for the 50 basis points versus the 25 basis points, not having another meeting until after the U.S. presidential election. So, look, we are in the midst of a very strong secular bull market. I agree with everything that Brian's saying. He's talking about a price target that's 7% higher from here. What gets in the way of that? Ultimately, for me, the only thing that gets away in the way of that is if earning estimates are too high, and we begin to price that in. Earning estimates of 15 to 20% growth in 2025, are they too high? This morning, we were greeted with the earnings from FedEx and Lennar, and the market was a little bit on a retreat from that. But other than that, the Fed is your friend. We have a disinflationary trend that's actually stronger outside of the U.S., Europe, Asia, outright deflation. We are recovering from an earnings recession. Looks like the NASDAQ's going to join that party. And you have the wonderful innovation from technology. So it's a secular bull market, plain and simple.
And Josh, I mean, the trend, as Belski said, as Jonathan Krinsky is talking about today, is higher. I mean, he says respect the action. Bulls gain the upper hand. He's going to be with us on Closing Bell later, but that's his note today. That's Jonathan Krinsky of BTIG.
So it's a technician who recognizes that the market is going up. It's amazing. Hey, no disrespect to anyone. I was in the airport on Wednesday afternoon, right as the Fed was making their announcement. I'm sitting there with Sam Rowe and Joe Weisenthal. They're like live tweeting it or whatever. And I see the knee jerk is a rip higher, so they wrote the algorithms right. And then they sell it down to almost flat on day. I think the Dow might have gotten to flat on day. And I remember sitting there sucking on a Jamba Juice being like, who the hell taught these people how to trade? I never understood this argument that the Fed was going to shock everybody and do 50, and then all of a sudden people were going to say, uh-oh, what's really wrong that they did 50? That never made any sense to me. It completely flies in the face of the history of these things. So the fact that we got 50, there's only one word that should be flashing through people's mind in that moment: buyback. That's what you're going to see between now and the end of the year. You now have a situation where corporations have incredible balance sheets and the borrowing rate is going materially lower, and they've got the earnings support to do it. And what's the easiest way to keep your job as an S&P 500 corporate treasurer, CFO, CEO? just authorize a bigger buyback. They're all in a great position to do it. It's actually an easier way to raise earnings than, for example, trying to pass on more price hikes to the consumer. Those aren't working so well these days. So that's what I think we should be expecting here. And by the way, market action is confirming. I don't just look at the blue line going up or down. I'm looking at components. 76% of S&P 500 companies are above their 50-day. 74% are above their 200-day. This is not just Apple, Nvidia, a bunch of semis, and a bunch of banks. This is literally the entire market, 3/4 of companies in their own individual bull markets, both short-term and intermediate term. If you need a technician to tell you that this is a bull market melting higher, I really don't understand. How long have you been doing this for? So there's a lot of counterintuitive talk. It never makes sense to me.
Jenny, you can look at inflows highest in 9 weeks, according to B of A, where you had outflows the prior week. I mean, the tone and tenor of the market seems to have shifted yet again. What do you think?
Yesterday made me really uncomfortable, and it has a bit to do with those inflows. There was a mania to it, a manicness that left me just uncomfortable, right? I actually had an interesting day on Wednesday. I was in client meetings all day. So I saw what the Fed did, and then I disappeared for 3 hours, looked back at 4 o'clock, and thought, oh, the market didn't really react much, right? It was kind of, like Josh said, Dow was kind of down or flat. The other things were down, mostly flat. And I thought, well, that made sense. To your point exactly, we all knew 50 basis points was coming. So why is it a big deal?
I don't know if we all knew 50 was coming. We knew cuts were coming, but 50 was 50 was a little bit of a surprise.
A little, but not much. The bond market going into it, all the expectations were for an average of 42 basis points of cuts, which leans closer to 50 than it did to 25. So I thought, on average, the expectation was for 50.
But I mean, the knee-jerk following the cut is, following the move is never right.
Fine, but stick with me for 1 sec. So then yesterday makes me uncomfortable. And frankly, Brian's $6,100 price target, that makes me a little uncomfortable too. Because on 2024 earnings, that's 24.4 times. Even if we get to, higher than those, even if we get to 274 in earnings, which is what Jim and I were talking about a couple weeks ago, you're still at 22 times. The last time the S&P 500 traded at 24.4 times earnings was 1999-2000. The last time it traded at over 22 times was going into the bear market in 22. So setting everything else aside, setting aside the mania, setting aside, the momentum behind this, those valuations make me uncomfortable. And I was taught way back when I interned for Laszlo Barini that one of the worst in leading indicators for a bull market was when the AAII, the American Association of Individual Investors, when they went hardcore bullish.
You know what the S&P is up this week? You know what it's up this week? 1.2%. Is that a mania?
Well, I think after yesterday, and up 20, okay, take a step back, it's up 21% year to date. That's pretty wild. Trading at 22 times.
Is that not justified?
I don't think it is. Because I don't think, okay, so it would be justified if someone could tell me, Jen, here's how you're going to get greater than 15% earnings growth going into 25. And that's something that no one's been able to convince me of.
Jen,
if you could,
economy good, Fed's cutting rates,
but go back
don't fight the Fed.
But go back to the conversation that you and I had a week ago. Okay, but all of those wonderful things, what do they get you? They get you 12 to 15% earnings growth, 25 over 24, right? We're kind of in between 250 and 274. You take those two numbers, you've got a 22 times multiple. So you're right, Scott, it's all great. But I
didn't say it's all great, but I mean...
Okay, it's fine, but I still can't get to robust enough earnings growth for me to justify a 24.5 times multiple.
Okay, and that's fair. That's her discipline, that's training, and that's how she looks at her portfolio. But as I looked at it, and I made the statement on Wednesday, and I think Joe agreed, that you had an unusual difference in opinion, where Fed Fund futures were saying, we're going to see 50, but yet consensus among strategists, among the dialogue narrative we hear on this network all the time leading up to was 25. So, yeah, there's always a knee-jerk reaction. Often there's a double knee-jerk reaction. So what? You have to look out to the ensuing days. And I think it was an appropriate move in the indices based on where the market psychology was going into.
Well, now what do we do, though? I mean, because Piper Sandler says the offense is now taking the field.
Exactly.
Is that fair? Is that the way to look at it?
Yes, and let me make that point, put a little color to that point. Now we're in a period, knowing that we have an aggressive Fed in terms of their easing policy, where bad economic news is going to be good news for the market. We went through that period where it was back and forth. Is good bad? Is bad good? Is good good? Now we're in a period where, unless it's disastrous news, a continuing deterioration in consumer spending and other factors that we've seen, right, will be good news. However, first we have to get through next week's economic data, which will play into what I've just said, and then earnings. If earnings guidance is going to be atypical, meaning extremely poor, extremely positive, that'll do different things. Otherwise, I think we're on a glide path higher. And I do believe that despite the 22 years where we've seen underperforming, have not seen this underperformance, whatever statistic Brian quoted, of the big cap companies, technology will lead. And we saw that yesterday where the NASDAQ lead. One more point.
Yeah.
If we're that easy to look at past periods and times, there's so many factors that go into it. We would not be sitting here because you just do it by machine, saying 1999, etc. So I think they inform your view, but I don't think you have to take it as
right. And just to be clear, I'm not super bullish. I don't think we have a big crack in the market.
What do you mean to be clear? That was already
Okay.
clear. That was clear and obvious. Did you mean you're not super bearish?
All right. I meant to say I'm not super bearish.
Oh, okay.
I don't think the
That's what I
market
thought.
crumbled. Thank you. Thank you for keeping me between the lines today. But I don't think it cracks and it crumbles. I think there's a lot of support there. I think there's a lot of rotation in leadership. I don't know what continues to lead. So
all right, so let's tackle that, Brian, because Wells Fargo looks back, and everybody likes to look back at history to try and inform their next decision. Wells says, so where do we go now? Looking back at the starts of the last 6 Fed easing cycles, the highest one-year sector returns were in tech. I like that they did this because it sets a good debate for us. Because I think intuitively people are thinking, well, now they're cutting rates. Now we should really lean, especially when they're doing it, as Waller said, into a strong economy, that we should lean into the cyclical areas of the market. We should lean into the small caps. We should lean into the financials. Tech leads all industry groups. What do you think?
Well, the analysis is obviously correct, and with a lower discount rate and risk-free rate, that'll affect these higher multiple areas, which are traditionally tech. But remember, too, some of these historical studies include a technology sector that also included communication services. Remember, that's a brand new sector. So if you take a look at names within the telecom space or communication services space like Netflix and Google, those areas were in that number one. I think the key thing here is that if you take a look at tech, which is a big sector, and you take a look at those kind of what we've been calling now for at least 10 years, the consumer staples tech of Apple and Microsoft, and the consumer staples communication services of Netflix and Google, if you keep those as your core positions, and what we've been doing, and have had the good fortune of talking on the show, on your show in particular, about what we've been doing with our tech holdings, is really moving down in market cap, of moving down to an Oracle and AMD and Qualcomm. And we think, too, that you want to diversify out your tech exposure. That's kind of number one. I don't think you should be so tough on Jenny. I think Jenny is this atmosphere.
What do you mean? She's being tough on
Jenny.
She said you're the one. Your targets are the one that are making her uncomfortable. You have
That's
a
okay.
retort to that? She said
She
says your target's too high. Your earnings estimates,
of course, I do,
are too high as well.
I actually want to thank Jenny for not being one that did not send me hate mail yesterday, because I got a lot of hate mail, and I'm actually surprised, because if you look at the way that Jenny thinks, and we had the good fortune of knowing each other for a while, and with the market broadening out and with interest rates going down, it's right in her bailiwick in terms of dividend growth and value. She should be happy this is all going on and the emphasis going away from maybe big tech and underperforming. But I think historically, going back to your question, consumer discretionary will do better. Consumer discretionary historically does better when economic activity slows. People seem to forget that. And I think you've seen a tightening up in performance overall in consumer discretionary. And I think that's why I keep going back to the mid-90s. This, to me, I was a young strategist in the mid-90s at a place called Dane Bosworth, and we were loving these big cap consumer staples names. That was really the beginning of the tech movement where earnings were driving. Lastly, on the earnings front, Jenny, take a look at my report that I published yesterday. If you take a look at earnings are accelerating in the 490 stocks in the S&P 500 and stabilizing with respect to the outlook in the 10 largest stocks. As you start to see that earnings dispersion and overall strength increase, that's going to help build credibility to this multiple and help build credibility to this bull market move.
And Brian, I think, if we're setting all jokes aside, the reason I'm comfortable pushing back on you on that too is because there is tremendous mutual respect. And I'm sitting here kind of desperate for someone to convince me of how we're going to get past that 250, right? And so when you're saying you can look at that and you can see the growth stabilizing at the top, accelerating at the bottom, I believe that to be true. I still can't get past how we get past 12 to 15%.
Can I ask you a question?
Hang on for one sec, because what I thought when I first read your price target, I thought, ooh, that's going to be interesting. Brian's going to have a reason that earnings aren't 250, that they're 280 or 290. How is he going to get there? So when I saw that it was really, to me, multiple expansion and that you were sticking with 250, that's what surprised me, because I don't like that big multiple. And I want you, I'm begging you, convince me how we go from 250, which is 12% growth year over year, to 274 to 290 in short enough order that multiple is therefore rationalized.
Can I ask a question that for Brian as well? Do you have to see the endpoint today, or can you see the momentum taking you towards there, which is what the market will follow? The market's not going to wait until 15 times has been in the bag and accomplished, or is it going to trade directionally like markets always do?
Just before you answer that, Brian, can I add one thing in to that? What's the time frame? Because I think the answer is directionally. We all know we get to 290 is in 3 years, 4 years, or in the next 18 months. Can you justify getting higher?
Can I just also say, I mean, those who have had a hard time getting their arms around the market over the last, year are the ones who've watched the train go by and have sat and said, wow, I just can't get my arms around the fact that the stocks are still going up. The price isn't right. I'm not going to single out any strategists who've made the prices wrong or this, that, or the other thing. And the train just goes to the next stop.
Can I add to that? Jenny, toot. It's still going.
Okay, and that's why I'm fully invested.
Okay.
Right? So just
but
because
where you
The
invest also.
question,
Okay.
the real question though is where to be invested. And Josh, I like what Barclays lays out today, because again, I've heard already in this discussion that, well, value is where you want to be. You want to be in the 493. And I'm not saying there are stocks within the 493 that aren't necessarily going to outperform, but Barclays looks at the past non-recessionary rate cut cycles. And yes, value does surpass the returns of growth, but only for a short period of time, immediately after the first cut, maybe 1 to 3 months. And then growth resumes its leadership role. As Dan Ives, when he was sitting with us at your great Future Proof conference, suggested that this is going to be the biggest boon for growth and for tech and the kinds of stocks that got us here in the first place.
Yeah, Scott, it's a really good point that you're making, but I think I would answer it a little bit differently. I would say don't worry about it. I don't think it's particularly important which one outperforms which over any given period of time, and I'll explain to you why. Year to date, the two top performing factors are exactly what most people would guess they are: momentum and growth. Momentum stocks are up 39% and growth stocks are up 27%, both beating the S&P 500. The two worst performing groups are yield and value. Again, this isn't like opinion. This is just pure factor analysis. Yield stocks are only up 13% and value are only up 14%. Jenny, I know you're doing better than that. You don't have to chime in. If you look at the last 3 months, though, that's flipped. Momentum and growth are the two worst factors in the last 3 months. And the reason why is because dividend and value stocks absolutely get an uptick when rates are coming down. The dividend stocks look more competitive with the 10-year. That's important for buyers. And, the value stocks and the low volatility stocks, they tend to be where people go at times of uncertainty. So I don't know the next 3 months. Does it flip again? To me, I think you could own both for different reasons. And I want to point out to the earlier point made, yes, we all agree that the S&P 500 on its surface is not cheap. But put that aside, I keep this list of the best stocks in the market. And when I look at the cheapest stocks on that list right now, every one of these companies is within 5% of a 52-week high. All of them are breaking out. Listen to the valuations here. Verizon is 9 times forward. AT&T is 9 times forward. Pulte is 11. DR Horton is 10. eBay's on the list. Royal Caribbean, Lennar, FedEx, all of these names, Deere, General Mills, Fidelity National, they're all under 15 times forward earnings. All of those names, I think, pay a decent dividend yield as well. So you don't have to agree that the market is a buy to participate in what's happening and make money right now.
Yeah. The other part of the debate obviously really sort of focuses around small caps. We had a CEO Council dinner the other night out in Los Angeles. Tom Lee was one of the guests there, and he, as you know, on Closing Bell many months ago suggested the Russell could go up 50%, small caps could do 50% this year. He was obviously hadn't performed near to that, but he still thinks that you could get a huge gain between now and the end of the year in the small caps because of the rate cuts. And Jeffrey Gundlach, told me he also thinks the Russell is the place to be. Listen.
If you go to the Russell 2000, you've got about 45% of the ex-financials that are floating rate, and they will have a tremendous benefit. So I think that while the trend of the S&P versus the Russell 2000 has been relentless, it has rolled over from a double top, and I'm pretty sure that this Fed hiking cycle will create much bigger tailwind for the Russell 2000 than for the S&P 500.
You want to take a shot at that? Belski, I'm going to come back to you for the last word in a minute on this topic, but Joe, I want to hear from you.
During my career, I've done much better reacting versus anticipating. You could anticipate that small caps are going to lead over the next 3 months, the next 6 months, the next 9 months, or you could react to the actual momentum beginning to present itself in the small cap equity size class and seeing the earnings growth, because the earnings growth is not there right now. So I will tell you this, look, in the wake of the Fed announcement, I watched the Russell. I was standing ready to do something in the Russell futures. I've been trading a lot of futures lately because I think the volatility is there. It's a good environment for it. And I was somewhat disappointed. Since the Fed's announcement, the Russell should have been the outperformer relative to the QQQ and the S&P. It's not. It's the QQQ where you're seeing the outperformance. So I want to react. I need to see the actual evidence presented to me that small caps have reached that inflection point. I'm willing to make the turn. Right now, I'm not.
I mean, still far and away, the Russell is the best performing sector week to date. Real quick, Weiss, and then I got to wrap it.
Yeah, I just think you have to watch out for financials in the Russells. I'd much rather play.
Well, that's why Gundlach was talking about, non-financials.
I know, but I'd much rather play actually the small cap in India, which I've added to that, and I've added to the large cap at 50.
All right, Belski, wrap it up. Last point on this topic. Then I'm gonna let you go.
We love the SMIDs. We've been overweight since the beginning of the year, but I think the thing that everyone's missing that you talked about earlier is that so many people try to make the big market call, Scott, and remember the stock market is a market of stocks, and focus less on the index and more on investing underneath the hood.
We're going to leave it there. I appreciate this big news, your target, and I appreciate you coming on with us to explain exactly why you did that. Brian, we'll see you soon. Thank you. Brian Belski, BMO, joining us. Breaking news out of D.C. Eamon Javers has that for us. Eamon.
Hey there, Scott. The FTC says it has brought an action against the 3 largest prescription drug benefit managers this morning. That's Caremark RX, Express Scripts, and Optum RX. The commission says the companies have engaged in anti-competitive and unfair rebating practices that have artificially inflated the list price of insulin drugs and shifted the cost of the drugs onto vulnerable patients. The complaint alleges that the companies rigged pharmaceutical supply chain competition in their favor with a perverse drug rebate system. The commission says that insulin drugs used to be affordable. One drug's list price back in 1999, Scott, was just $21. The same drug today, they say, lists at more than $274. And the commission says that today, 1 out of 4 insulin patients is unable to afford their medication. There's also a warning in here to other companies involved in a statement from the FTC's Rahul Rao, who says, while the commission has exercised its discretion to move forward with suing only the PBMs and GPOs now, the FTC's staff investigation has also shed light on the concerning and active role that the insulin manufacturers, Eli Lilly, Sanofi, and Novo Nordisk, play in the challenged conduct. Now, Scott, we don't expect a resolution of this anytime soon. This is just the beginning now of a proceeding in which the allegations will be tried in a hearing before an administrative law judge. We're going to reach out to the companies involved to get their reaction as well. And Scott, back over to you with this idea here that not just these PBMs involved here. This is clearly a shot across the bow of Eli Lilly and some of these other drug manufacturers as well.
No doubt, Eamon. Thank you for that reporting. Can we throw up these stocks, guys? Please, Lilly, Novo, those are the ones that we should, these are the ones that are obviously involved in the action, but it's the threat, if you almost want to take it that far, towards the other names that I think matters a little bit more. Can we show those, please, if we can get those up? I want to see Lilly and Novo and really the ones that Eamon was talking about. There we go. We'll just keep our eyes on those. Obviously still in positive territory, but you can see what the trend line, at least on this day, looks to perhaps be doing. But we'll watch that for certain. We'll take a quick break. And there you go. There's Novo as well, which is down about 5 1/3%. Again, we'll watch that based on what Eamon has just reported from Washington, D.C. We'll do our chart of the day next. You know about the Nike news by now. Is anybody buying the news of the new CEO? We'll ask the desk next. Chart of the day today is Nike, because of that news that came out late yesterday. John Donahoe out. Elliott Hill, a company veteran, is in as CEO. Stock year to date is down more than 20%. I got any buyers here? Anybody who was looking at this stock and was waiting for some sort of transition? No?
I'd love to, frankly, but, it's the first time I can recall in all the years I'm following Nike that there is actually true sustainable competition from on-cloud. Hoka, I think, is more of a trend because it's tough to keep that kind of look going. But I think it opens up the door for other competition as well. And that's
still like the big behemoth. Let's not make it out. Let's not make it out that all of us. You don't think any of this competitive stuff is overblown? Maybe there were some missteps on Nike's part. Lack of it itself.
I don't think it's the first thing. I think
lack of innovation.
I think what it shows that Nike's brand really has to be refreshed because it's been the same shoes, different colors, and some slight modification. So you just got to refresh at some point, number one. Number two, the cost of bringing in athletes has gotten much more expensive. So I just think at this point that you really need innovation and new ideas.
I think if you're buying the stock today, you're buying it on the premise that this could be something similar to what we witnessed with Chipotle and Brian Nickel. And I don't think that's the possibility here.
I agree.
Elliott Hill is a very qualified executive, and I'm certain that, there's going to be execution and he'll take the company in the right direction, but it's not the similar type of setup that you had with
it's also a longer road to turning around a manufacturing company with huge supply lines and design than a fast food company.
So from a just straight up fundamental analysis perspective, here's where we're looking at it. We're seeing increased competition, slowdown in athleisure wear, pressure in the Chinese consumer, and a stock that's trading at 25 times earnings with no earnings growth over 4 years. Super uncompelling.
Too expensive is
Too
the argument
expensive.
to make.
No
Josh,
earnings growth.
how do you analyze Nike here?
I have to agree with what everyone said on the desk. To Steve's point, they're still selling Dunks Air Force Ones for about $110 a piece. That's basically a staple at this point. It's not in fashion, it's not out of fashion. It's just like an evergreen thing that they can do. The Jordans in the secondary market are not selling for what they were selling, which has like a ripple effect, and so the new Jordans are less in demand. And then what comes next? It's unclear. They really haven't innovated a whole hell of a lot. Even their best signed athletes are all aging out. Like, do kids want to buy LeBrons right now? Not really. What about Kevin Durant? Is anybody lining up for the new Durant drop, like under the age of 12? I don't think so. So it's a tough time for them. You've got this leadership transition. I don't think the guy's in any rush to make changes. So next quarter is not going to be the turnaround quarter. And Jenny nailed it. Why would I pay 25 times forward earnings for a turnaround story? Nobody does that. So it's kind of in a no man's land. And that's why the rally already fizzled out. Everybody sees the same thing.
We'll do our calls of the day. We start with a bullish note on a stock Josh bought a month ago. It's up nearly 10% since then. We give you the name. We talk about this trade in the road ahead when we come back on the half, just a couple minutes. I want to show you an intraday chart of the Dow Jones Industrial Average. Well, there's the price on it now. Positive territory by 55. you want to throw up an intraday of Apple, we're going to give you a large reason why the Dow is now positive, back above 42,000. Remember, it was down by more than 100 points, but this chart right here has a lot to do with today's story. Joe, as you were noting just a moment ago while we were away, Apple on the move. The phones are on sale, obviously. Kovac was outside the store on Fifth Avenue. Tim Cook in the house. And all the above sounded pretty optimistic, despite some notes that would suggest demand is a little lackluster at this point.
Yeah, well, we talked about that on Monday, and everyone was trying to get their arms around these notes. And what we said at the time is you just don't bet against Apple. Okay, Apple could go $10 higher, $10 lower, but I'll tell you this, over the next 12 months, the trajectory for the company is going to continue to be price appreciation because the company stands behind its stock and aggressively buys back its stock while it tries to deliver on some form of innovation or some form of taking an existing product and improving upon that product. So while we try and all understand what Apple Intelligence ultimately is going to be, again, I urge the viewers, if you're in the stock, don't treat the stock in terms of where the tactical move is going to be. Look at this stock in terms of where it's going to be over the next 12 months, and everything suggests this stock has the tailwinds behind it to continue to move higher.
But let's be honest. I mean, you're not buying this stock alone on the buyback. You need the upgrade cycle.
No, but the buyback defends the possibility that this stock can have a major inflection point. And there's been so many times where in the last several years you could say to yourself, okay, this might be a major inflection point for Apple. The problem and challenge in that thesis is that the company is going to stand in your way and they're going to reduce share count with an aggressive buyback.
Sure, but you may suggest, okay, that puts a bit of a floor in the stock, but you get a bigger ceiling by the upgrade cycle.
Absolutely. You do get a bigger ceiling by the upgrade cycle, but the buyback is the bridge that allows you to get to that moment where you gain the understanding of what innovation surrounding new products is going to ultimately look like. Look, Apple Intelligence, I don't think we have our arms around what it ultimately is going to be.
All right. Hey, pal, let's show that chart because Mizuho today reiterates their outperform buy with Prime time. They say it's now available at Buy with Prime and check out Amazon. Josh was highlighting this the other day. You want to talk about this?
Look, I think the story here is that Alex Christ, the new CEO, is very quietly making really big strategic deals behind the scenes. I do expect something with the near field communication chip that Apple is now opening up. I think you're going to have Pay with Venmo be a viable option at retailers all over America. And I think what you're seeing here with some of these things with Amazon and Shopify, also we didn't talk about in the last week, these are just really smart ways for PayPal to reassert itself as one of the easiest ways to do e-commerce. And the market likes it. So this stock remains a top-tier performer. It's making new 52-week highs. Almost nobody is paying attention to it. It's a little bit beneath the radar. It's not a mega cap tech. It's not a fast-growing company. It's definitely a value stock, but the trend is up, so I'm going to stick with it.
All right, we'll take a quick break, and we do have Weiss adding to one of his positions, a new move. We'll break down the trade, and Mike Santoli is going to join us with his midday word next. Markets commentator Mike Santoli has sat down here at our desk at Post 9 for his midday word. Been a week. It's been a week. So what's on your mind here as it wraps up?
I think you can say, I mean, as the market is kind of telling us, the don't fight the Fed, don't fight the tape rules are firmly tailwinds at this point, big picture. We do have, I think, Waller's commentary about a Fed that's kind of almost looking for reassuring inflation numbers to justify a move further toward neutral. All makes sense. You know, you have to be aware, not so much of the seasonal patterns, but the fact that we did have this burst higher, make a new high. It's well grounded in breadth and everything else. But last month in August, we had that huge rebound after the Friday options expiration, which is today. You kind of flattened out. That was basically your gain. So you have to be open to the idea that maybe you have to digest this a little bit. And then the earnings flow. I mean, it wasn't great last night on the reporters that we got. And see if that really is starting to matter to the market, that becomes more sensitive to ideas of a slowdown.
Some of the notes that I've read today and I've cited on our show would suggest it's not so obvious, or certainly not as obvious as it might seem, on where you want to be post-rate cut.
Yes.
within the market itself.
It gets a little noisy if you look at the history. For example, tech kind of underperforms. Even cyclicals, don't immediately kind of grab the baton and run after a rate cut. I think big picture, if you don't overthink it, is all that matters is recession or no in 6 months in terms of how the market behaves following a rate cut. And, that's why, you have to kind of track every piece of incoming data, but there's nothing to be too alarmed about at the moment. Credit certainly isn't worried.
Yeah, the don't fight the Fed historical playbook would suggest that everything can go up in a post at the beginning of a rate cut cycle. Some things may perform better than others. I'm not suggesting that, but
of course,
if you look back I just go back to what Tepper told us, and it was either like late 08 or early in 09. Like, what's going to go up? I don't know. Everything's going to go up.
That might have been even 2010 when they were just basically saying we're there. It's not quite the case. In fact, yesterday people were complaining there weren't enough stocks making 20-day highs. It wasn't a all-in momentum move upside.
All right, good stuff. I'll see you in a couple hours on the bell. It's Mike Santoli. Weiss adding to one of his positions. We'll do that next. All right, we're back. We want to get to this move we talked about that I've teased numerous times, Weiss. You added to what?
Vertiv. If you recall, I got out of it about 103, re-entered it between 79 and 82, added yesterday before Fed, and added this morning in the Constellation Microsoft news. There's just an insatiable appetite for data centers, and they are the premier company making the cooling racks for these servers that run so much hotter than the old CPUs. So I think it goes a lot higher. It got cheaper. I sold it in valuation because no margin for error. Stock just got a lot cheaper on the decline, so I like quite a bit.
Given your what certainly sounded at the top of the program a pretty bullish, constructive view on this market, you looking to do anything else? You looking
I'm
to
pretty fully invested. I've got the lowest cash I've had. I've been adding back to it over time after I trim some back and taking the opportunity to do what I love to do, which is build core positions when stocks get hit from what I perceive as not ongoing events. And that was true of Alphabet, which is now actually my largest position. And that was true of Meta when it happened, and Netflix. So that's the formula I'm going to continue to use. I'll scale back those like I will Alphabet at some point because it's just too big.
All right, we'll take a quick break. We'll do finals next. Let's do finals. Josh Brown, what do you got?
Don't tell anyone, but Samsara, new all-time record high.
Okay, Steve Weiss.
Yes, I'm going with the India trade. Declining rates are good for emerging market economies, plus supply chains moving there. So SMIN and INDY.
Okay.
Jen.
Thanks. One from our growth portfolio, Aptiv. They do the wire harnessing and safety systems in cars. It trades at 9.5 times earnings and has 20% earnings growth for the next 3 years.
There's a tremendous need for carbon-free power 24/7. That's exactly what happened today with Constellation Energy and Microsoft. Other technological giants are going to follow suit and secure the output.
All right, I'll take you through the final stretch of the week. It's good to be back with all of you.